everybody, welcome to this edition of my monthly newsletter. April is here. You know what? Spring has sprung. Don't know if I would say it actually feels that way, but we've had a couple good days of sun here coming up. So today I just wanted to touch on a couple topics, a couple things that have come up recently in terms of Bank of Canada announcements, what we're seeing in the fixed rate and variable world right now, and the difference between the two, and an upcoming event that I have come up here at the end of April. So big thing to talk about right now is the Bank of Canada has held their rates over the last two announcements, which is fantastic. So with that, we have seen inflation going down. We have seen our economy slowing down slightly, which is good, which means that with that, these rate increases that we've been having over the last year or so, it's working, right? So we're starting to see that the inflation is going down. They're anticipating it to be down to approximately 3% by the end of the year, which means that the last two Bank of Canada announcements, one that we had this week and the one that we had just a month and a half ago, they've held steady. They have not changed the rates, which is great for buyers. People are, getting off the fence. People that have been wanting to get into the market over the last, say, year and a bit, but have been a little bit nervous in terms of what's going to happen with interest rates. Are we going to see them go up like crazy, like we potentially had, say, back in the 80s, seeing interest rates in the 17, 18%? We won't be seeing that, which is fantastic. And, in the end, even though it was aggressive, it's done its job in the sense of we've had these rate hikes. I wouldn't say, however, we're out of the woods just yet. It's really going to be important to see what our GDP does, what inflation does, what the job market does over the next couple months. Because if any of those numbers do start to steer away from what the trends that we've been seeing, the Bank of Canada very well could increase rates even more. Don't see them decreasing them anytime soon, potentially end of this year, as from what we've been hearing from most economists is we're going to be dipping into a recession. So with that, what are we seeing in the market? Like I was saying, more people are getting in, more buyers are looking out and starting to look at purchasing. But with that, inventory is not very high. And, we're starting to see some people go competing for multiple offers. I've had a couple clients looking at doing subject-free offers. So realistically, hoping, as we get more into spring here, the inventory picks up. And, the people that have been sitting on the fence, they're able to get into something at, asking price and not having to go way above in terms of getting into multiple offers and subject-free offers and stuff like that. That being said, a couple big things that has happened as well is even though we've seen a stand in the prime rate and the overnight lending rate here with the Bank of Canada, we have seen bond yields fluctuate like crazy. And the bond yield is going to be what's dictating fixed interest rates with the bank. So fixed interest rates, we have seen them go down significantly. We were at the point where, right now we're still seeing low sixes for a variable rate, where a fixed rate, it's not uncommon to see a mid to high 4% 5-year fixed rate for insured and conventional mortgages. So right now, we're looking at more options in terms of if a client's, say, getting into a new purchase or, they're doing a renewal, say having currently a variable rate coming up for renewal, they're like, hey, what do I do? It's not a horrible idea to go into a shorter term fix, say a 3-year fixed option, take that great interest rate, which, it's a percentage and a bit difference, ride that out for 3 years. And then hopefully 3 years from now, we're seeing these fixed rates change. So that's the big thing. And you know what? I do believe that these bond yields are going to fluctuate. It's going to be a very interesting market over the next couple months here. They're going to fluctuate up and down. However, they have, pretty much held steady in the sense that over the last 2 months or so, seeing a fixed rate in the 4% is definitely not uncommon, which is great. So definitely a bit of a change in terms of, strategy where, the person that, as we always say, 9 times out of 10, you're going to win with the variable. Right now is not one of those times. And, the fixed rate can be a great option. So with that, I wanted to discuss a little bit more about what is the difference between fixed rate, variable rate, and even what an adjustable rate mortgage is. So they're kind of the main three. The variable and the adjustable rates are morphed a little bit more into the two. They're similar. They're both dictated by the Bank of Canada's overnight lending rate, and then in the end, the prime lending rate that the bank set out. But I'll start off with the fixed. So the fixed rate, like I was saying, is dictated by the bond yield or the bond market. So as bond rates do start to drop, we see the fixed rates drop. If they start to rise, fixed rates are going to rise. The fixed rate, however, is going to be a fixed payment over a certain amount of terms. So whether that's a 1, 2, 3, 4, 5-year term, you're going to be setting that up that your payments are going to be the exact same for the entirety of that term. And the reason why I'm saying kind of like, oh, hey, we should be looking at a 3-year fix rather than a 5-year fix right now is for the big part is the penalties that are going to be associated with breaking a fixed rate mortgage. So fixed rate mortgages go off of the higher of the two, one being either a 3-month interest penalty, so basically what you would pay in interest over 3 months, or an interest rate differential penalty. And basically the easiest way to explain what an interest rate differential penalty is if you were to be locking in at a rate, say at 5% today, and then in a year from now, rates go down to 4%, but you're wanting to break that mortgage. And what I mean by breaking the mortgage is, you want to refinance, you want to sell your current property and buy something else, pay off in full. There's so many things, that we could look at what you need to break the mortgage for. But with that, basically it's that percentage difference. So that 5% going down to 4% is the lenders are going to want that difference that they would have earned at that higher interest rate over the remainder of your term. So that 1%, say you had 2 years left on your term, they'll want 1% for the rest of that term so that they feel like, they committed to you at this interest rate. They want, the money that they feel like they would have earned in terms of interest. So, sure, you may be leaving them or sticking with them, whatever that may be, but you're probably getting into a better interest rate at that time. So penalties can be substantial, especially in an environment that we're in right now where, we're hoping that we're at our peak and we should see the fixed rate start to drop over the next year or 2 or 3. So at that point, your penalties are quite large. So going into that shorter term fixed hopefully eliminates that, but you just got to plan and strategize that, you're going to be in this mortgage for 3 years. For a variable and adjustable rate mortgage, they do go hand in hand. They're both dictated by the Bank of Canada's overnight lending rate, and then the prime lending rate that's set out by certain banks. Most banks are going to set their prime rate currently at 6.7%. Some banks, like say TD, they have their own prime rate, which is just slightly higher. So with that, a variable rate is what is basically your payment is static. And what's going to change when the Bank of Canada changes the rates is the difference that you pay on principal versus interest. So as rates go up, you pay less in principal, more in interest. As rates go down, you pay more in principal and less in interest. It also will change the length of your loan and how long it will take to pay back. So your payments don't change. There are points where you can hit trigger rates, which I'm sure many people have hit over the last year or so as we've seen rates start to rise. But basically it's at the point where you're only paying interest on those monthly payments and there is nothing going towards your principal. So at that point, the bank, of course, asks you to increase your payments so that you're actually paying down your principal to a point that makes them happy. Where an adjustable rate, also dictated by the Bank of Canada, your payments are actually going to fluctuate when the interest rates are changed. So goes up 0.5%, your payments are going to go up the equivalent of 0.5% of interest rates with that calculation. So it is a great option, and I really do like the adjustable rate right now if you wanted to get into that type of product. Just because as we hopefully see rates start to drop later on this year, early into next, you don't have to worry about, you're still having that high penalty or high payment. Your payments are just going to drop. So it's nice in that sense. And then the big difference as well, as I was talking about for the prepayment penalties for the fixed rate, is with the fixed or with the variable and the adjustable, no matter what, doesn't matter where the rates are at, to break that mortgage, you just have to pay 3 months of interest. So it can be a great point for the utmost flexibility that, say, you're getting into a property right now, say it's an investment property, and you want to make sure that you can break that mortgage at any time, say to take out more equity to buy another one. That would be a reason to stick with a variable, just because, you have that utmost flexibility with the penalties. So Other than that, that's the main thing that I wanted to talk about in terms of fixed versus variable and adjustable. One more other thing to note is I am hosting an upcoming mortgage financing seminar. It's going to be held April 25th at 6 p.m. At Moody Ales. It is limited to 30 people, so if you guys are interested in coming, in the link of my newsletter, there will be a link to RSVP. If you guys could just do that so we make sure that we can have numbers and know exactly who will be attending, that would be fantastic. But other than that, as always, if you guys ever have any questions, feel free to reach out, email, text, call, whatever it may be. Respond to this email, book a call. It's all in this newsletter, but looking forward to chatting with you guys next month, and have a good one. Thanks.